Now, ladies and gentlemen, as you all know, that for the year 2012, the watchwords were only two: fear and skepticism. But this year, the watchwords are recovery and hope. Fear is no longer occupying global center stage. Reforms have kicked in. Inflation hopefully has topped out and earnings have bottomed out. But the question in front of the panel, and something which we would be debating, is that with good news, has hope or complacency also set in? Is this as good as it gets for Indian equity markets, or this is the beginning of the new bull market? With that introduction, let me turn to Ramesh. Ramesh, exactly a year ago, your famous line for 2012 was, good news and good price, they rarely come together. Right now, news is good, but is the price also good?
I think so, Nikunj. I think it's, as the title very appropriately suggests, we're in the early stages of a new bull market. We've been in a very bearish phase for 3-4 years after the 2008 fall. Bear markets don't last forever. Life goes on. A lot of bad news was discounted in the price, and the market's moving ahead. And just looking at the amount of ownership that Indian equities is so low, the lack of frothiness in the market, people not even believing. I think India's lust for gold and real estate. And there will come a time in the next few years when they lust for equity. And until that happens, I think the bull market is intact.
What's your understanding? You're an expert of behavioral finance. Classify the big picture for us.
The odds are in favor of the market doing well, simply because if you look at the last 5 years, it's been a pretty barren 5 years. And anyone who sort of is a believer in mean reversion will know that the best time to probably get into markets is after returns have been very poor in the preceding period. So by that definition, this should be, I think, a period where you have the likelihood of the markets doing well going forward. But I don't think it matters whether we have bull markets or bear markets, because the ability to create wealth in the stock markets is not a function of how an aggregate market is valued. If you look at from 1992 till roughly 2000, I mean from the Harshad Mehta top till the .com top, I think in reality in 8 years you would have not seen any great compounded return. Yet there are many people here I can think of who would have done exceptionally well in that period. They would have created incredible wealth, provided they were in the right places. So at that time the right places were IT services and pharmaceuticals. And of course these change. So to me, I think it's important. Yeah, it's likely that you're going to see the market going, headed north. But I don't think that's the real essence of whether there's an opportunity to create wealth. The opportunity to create wealth will be the ability to identify companies which are well prepared to cope with the future.
Bharat, the ring of a new high is nice. We all want to hear that ring. But would you agree with Sanjoy's assessment that the bull market already has started? It's all about stock picking, like you say. Buy good quality companies, bet on businesses.
I'm not too sure about whether this particular year that we are talking about or period we are talking about is on a bull market or not. I'm a little more, so to say, cautious. I think last year actually offered a better value, and all the behavioral aspect of the market suggested that you couldn't have lost, you could have only gained. So to that extent, the game was significantly in favor. Right now, there seems to be an overabounding kind of a belief that markets will rise, and I'm less confident of that. That doesn't mean that you will not make money if you have chosen well. I think there are plenty of opportunities to make pretty good returns.
Prashant, over to you. After a 25% run up in last 1 year, how does one figure out or judge that all the good news is not in the price or it is in the price?
See, it depends on the time frame what you take. Because equities, to my mind, and that's what many experts have said, that over short to medium periods, it's extremely hard to forecast equities. And the longer you think in equities, the more reliable an asset class they become, and the more reliable our predictions can be. I have seen that in the worst of times, even when there is a crisis, let's say September 01 or 2008, the PEs in India did not go below 11 odd times. And today there is some stress on the economic indicators, but there is no crisis as such. So I would believe that the downside in the markets, going by past experiences, maybe 11 odd times. And we should be near those PE multiples in 1 year from today. So I would agree with Sanjoy when he said that the risk reward is favorable, particularly if you take a 2 to 3 year view, because India is a secular growth economy. And I think the worst of current and fiscal account deficits is behind us. And as we go into next year, things should get better. Interest rates should head lower. And therefore, there is room for PE multiples to move up over time.
Ramesh, you've always stated that investing is not a science, it's an art. You have to be street smart to make big money. Now, we often judge the Indian retail investor as a benchmark to judge whether there is euphoria or not. Yes, the Indian retail investor is not there, but the global investor is there. Do you think this time around, a lot of euphoria has got exported?
It's a good analysis, Nikunj. Yes, it has got exported because every day like clockwork you're seeing 1,000 crores of equities being bought, and primarily in large cap stocks. That is why the cash has been a bit poor. But it is my strong belief that by the time this bull market is over, the Indian retail public is going to come back and buy shares. And my point is that there are only 200 to 500 good quality companies in India. And they will not dilute equity because you want to buy shares. So that means the PE multiple will only expand with these companies. So now is a good time as any to get into equities, because once you want to be on that ride when the PE multiple starts expanding in India, there is so much, you're a young audience and you need to understand that there is so much under ownership in Indian equities by the Indian public. I mean, folios are being closed. No one wants to get into equity markets. It's a shame. We are lusting as Indians for gold and real estate. And in my opinion, at least, they're more at the top of the cycle rather than at the bottom of the cycle. You need, as young people, looking at the next 10, 20 years, to increase your exposure to equity. So, I truly believe that, yes, the foreign investors come to India, but by the time this bull market unveils its flags, the Indian public is going to come and start buying.
This is a market that is dependent substantially on foreign money. And if the foreigner perceives this as the least of all evils, because that's really what he's got to do. He's got to look at, where he deploys his money, and he doesn't have that many choices of large markets where he can put substantial amounts of money to work. So if he makes that judgment that this is a good place to be, then yeah, the market will go up.
Prashant, since we are talking about addressing student audience here in this round at least, how do you invest? What is your style of investment? What would you advise to the young student audience here?
How I go about investing is, we focus on sustainability of a business. Because when you are buying a business at X multiple, you are assuming that the business will generate cash flows into the future. So sustainability of a business is extremely important. So we try and stay away by and large from businesses which do not have any meaningful competitive advantages. We also believe that the management's quality should be reasonable and there should be fair treatment of minority shareholders. So these are hygiene factors, and so we would not invest in businesses where either the business quality or the management quality is below a certain minimum threshold. After this, how you go about selecting businesses, we focus on growth prospects and on what you are paying for that growth. And what I have observed in my experience is that markets are inefficient over short to medium periods of time. And wherever the growth is high, and the markets always, or most participants, love growth, and they simply extrapolate the short-term growth into the long-term. And that is often not sustainable. And so I have seen that if you think long term, you are able to make better judgments about the value of a business. And if you are buying something at very high PEs, which implies very high growth for long periods of time, chances are that there is a mistake there and you are unlikely to make money. On the other hand, businesses which are fundamentally good but are running into some short-term problems, I think I have seen in life and in stock markets and in businesses, there is something called a mean reversion. And so we should not always extrapolate blindly the past into the future. And if you think long term, I think this kind of approach gives you very good investment opportunities.
Ramesh always follows a different mantra, because 2 years ago, for the student audience, he had identified the importance of value, importance of buying cheap. How does one judge that? A beaten down stock will always look cheap.
Nikunj, this is the heart of the business. Cash flow is very important. I look at it all the time. P is very important. I look at it all the time. But at the heart of valuing equities is valuation. And since you are 18, either you get it or you don't get it, And how do you value a business? You can value everything in life, all right? The simple way, of course, is the outstanding shares times the current market price, gives you the market capitalization. You add the debt if you want, that gives you the enterprise valuation of a company. And then you have to learn using your judgment. Is this cheap or is this expensive? Is this attractive or is this, very expensive? Let me give you an example. At some point in my career, I came across the liquor industry. It was available for 200 crores. The Indian liquor market was available for 200 crores. Think about it. 100 crores of people, 51% of the people getting above 21 years of age, good times rolling, the economy growing at 8%, a non-Islamic country, so there's no prohibition against drinking, and you get the entire market for 200 crores. That is the benefit of doing an analysis. Now you just have to figure out the trigger for change. Why is this 200 crores? Why can't it be 2,000 crores? Or why can't it be as it is now 20,000 crores? That's the heart of the business. So my first request to all of you is look at valuation. Just try and understand what a thing is worth. Cash flow, PE, growth, all just are part of that valuation exercise. At the heart, being a value investor is understanding how the market is valuing a business. And occasionally in bear markets, in panics, in crashes, markets give you extraordinary opportunity to accumulate wealth. At that time, the only mistake you can make is not backing up the truck and buying. That's the big thing about equity markets. They can make 5 times, 10 times your money. If you go back and look at the 2008 crash, go back and look at the 2000 crash, go back and look at the 92 crashes, people who held their nerve and bought good businesses at throwaway rates made out like bandits. That's the key to the stock market, in my opinion.
Ramesh, you're making a case that the odds are stacked up in favor of going long, but I don't see any distress in any of the good quality companies. In fact, most of the good quality companies, whether they are good brands or they generate good cash flow, they're trading at historic high. So how will this market create wealth?
It is a matter of understanding the sector. I mean, one sector which Nukunj, you and I have talked previously, say the media sector. I happen to like that sector, and I'm only saying it as an example, not necessarily that you should follow this. But you will find that the media, and what really amazes me is media people themselves are bearish on the sector, So
that's an opportunity.
That's a great opportunity. They're so cheap. I mean, if you go back and look at the market capitalization of these companies, I scratch my head. Ramesh Damani, can sit here and become Rupert Murdoch of the world today by buying significant stakes in listed companies in India. All right, some of the stocks have already moved up, some may move up tomorrow, some may go down. But it's the call I'm making. First, they're cheap. Is there a trigger for change? What is going to change the valuation of these media companies? We have a digitization bill that passed in Parliament. In fact, that was one of the first economic reform measures that passed in September. That changes the economics of the business for the first time. The money, instead of going to the local cable operator, now goes to the middleman, goes to the broadcaster, goes to the cable operator. So that is changing the economics of the business. And that will, the effect on the balance sheet, on the profit and loss, will be in 12 months, 24 months, 36 months from now. But right now, these stocks are cheap. If you go back and study global media companies, you realize what great businesses they are, the kind of cash flow they produce. Looking at the future, valuing a business correctly, looking for a trigger for change, and then being patient, sitting on your rear. Rome wasn't built in a day. Great businesses are not built in a day. It takes time for a company to mature and, believe in its investment hypothesis that you started with.